Tim Kerley here with your Friday FAQ, and this week's question is all about debt ratio. This may seem obvious, but I think I'll probably give you a little bit more insight into what the debt ratio is, how important it is, and particularly what goes into that debt ratio calculation. Now, you will hear some people, call it a debt ratio. You might hear DTI, which is debt to income ratio. It's all the same thing. In calculating your debt ratio or your borrower's debt ratio, what the lender is going to do is take all the monthly debt payments, add those all up into one lump sum, and divide that figure by the monthly gross income. So this would be, income including salary, bonus, overtime, if the lender is able to count that, Social Security income, retirement income, anything like that. The gross figure, this is before the borrower has any deductions or has any taxes taken out. So monthly debt payments divided by monthly gross income, and that gives you your debt ratio figure. Now, a few things that are included in the debt ratio that you might not think about would be stuff like alimony, any child support, anything that by a court order or any kind of a divorce decree, separation agreement has to be paid, any kind of a court document, that's got to be included in the debt ratio. Student loans, this big thing with student loans right now, they're all in forbearance. So most people are not making their payments on the student loan. There has to be a payment counted in the debt ratio for those student loans, even if they're in forbearance. Some stuff that would not be included in the debt ratio would be like utilities, health insurance, auto insurance, anything like that. And insurance, obviously homeowners insurance would be counted because that's part of the housing expense on the home that the buyer is getting a loan on. So that has to be counted in there, but other types of insurance would not be counted in there. Now, lastly, let me just say, debt ratio is very, very important because it really gives the lender there's other things too, but it gives the lender a good indication as to whether this person has enough income to be able to support this debt and whether they can make the payments. So, in some cases, the debt ratio is a hard stop. I think of some of the down payment assistance programs, 43% is the debt ratio. So if you are 43.01, that's a hard stop. And the borrower is not going to be able to get assistance with a debt ratio over 43. You got to find a way, if possible, as a lender to try to get them down below 43%. And then, if you're in the low 40s with a good credit score, most of the other programs, you're okay. You can go well above that if you have a good credit score. Maybe you've got some money in the bank as reserves. So I think in one of my other videos about credit, I was talking about how, credit score is important, and you do get, it's not everything, but you get more leeway on the underwriting if you have a high credit score. So debt ratio would be a situation where that might come into play. If you've got a really high credit score and you've got a credit history for a number of years, that would kind of indicate to the lender that, maybe your debt ratio is a little bit out of whack, but you can still manage your debt. And when I talk about the lender, really a lot of it comes down to the automated underwriting systems for each one of these loan programs. They're going to tell the lender whether it's acceptable based on their algorithm and everything, with a debt ratio of, let's say, 48 instead of 42. And that happens quite often, again, with somebody that's got really good credit. On the other hand, if you got somebody that's got a borderline or really low credit score, they're not going to get very much leeway on the debt ratio at all. So I hope that gives you a little insight into debt ratio. Have a great weekend, and we'll see you soon. Bye.